Hey traders, welcome to Charts and Coffee. Great to see everyone. All right, welcome. Hope everyone's having a good, peaceful Friday so far, because we have options expiration coming up, and that is going to be rife with shenanigans. This, I will tell you, I think it's really important for every trader to be self-aware enough to say, hey, there are certain days of the month or certain days of the year that just don't lend themselves for any reason. It could be volume, it could be volatility. For me, it's volatility. It could be any number of things where our win rate doesn't merit putting our hard-earned capital at risk. And for me, and I'm telling you, after over 30 plus years, end of quarter, especially end of Q3, is a really wonky time. My win rate is reduced to basically a coin flip. It's not that it's a bad day. It's not that it's a good day. It's basically flip a coin and let's see what happens. And I know that unless my win rate is sitting at about 60%, I really don't have an edge. If my win rate's 50 something, then why trade? I mean, if it's just basically flip a coin and right. So in my mind, 60 something's the minimum for anything to be valid. Now, I will say while we're talking about win rates, too high a win rate is no good. Too high a win rate tells me it's one of two things. One, I am purposefully, consciously optimizing for faster take profit levels. I am purposely saying, look, I am very mistrustful and I want to take profit quickly. So it's a conscious take profit more aggressively. That's one reason to have an extraordinarily high win rate. What's extraordinarily high? Anything over 80% simply means profits are being taken too soon. However, if I'm not purposely doing that, which is fine, this week I've been purposefully taking profits too soon because I don't trust this market any further than I can throw it. So right now we actually haven't had a loss. That's not impressive. What's really the focus is we've been keeping risk very low, and we're able to focus on more aggressive T1s so that I can move to break even sooner. The purpose of an initial target, gang, is not to pay yourself. It's not to 2x your initial option premium. It's how quickly can I transition from risking my capital to risking house money. And that's the mindset of a T1. So that's what we've been doing this week. And it's worked really well. I was perfect. I was actually ready this week to talk to everybody about the discipline of stop losses and discipline of position size and sticking with the process through tough times, because I was expecting losses. We didn't have one, but I'd say the real reason for that is a very aggressive T1. Again, if next week I'm operating at 80+% win rate, I'm taking my profits too quick. So those are a couple things, a couple takeaways from this week. And ask yourself, if you were struggling this week, could you have taken profits sooner, consciously, and then realize that next week or maybe into the second week of October, you can loosen the reins up a little bit and try to let these markets move in your favor a little bit longer, right? So if anything, I left a lot of money on the table, but by design. So, ways that we can control risk by controlling our first target. Think about that and see if that helps. The other thing that I think is interesting about the only way to understand which days are really tough, and I'll share this with you all next week. If you haven't checked out countdowntrader.com, I'm going to share my trades viz like we did in August. I'm going to share my trades viz for the month of September with you all. So a couple of things. When I'm sharing the trades viz with you all, when I'm sharing the trade results with you all, these are trades taken in the mastery, because my mastery trades are my trades. There's not trades that I'm taking in some dark corner of the traderverse, right? And then I come back and say, hey, look at the profit I made. I don't even talk about those because I don't do them, right? If there's a trade I'm going to take, I'm going to do it with the room. So when I share with you all my trades viz, those were not only my trades, but those were all mastery trades. And we'll talk about the day trades that we took throughout September, because that's all I did, right? It's keeping that short-term approach. So very much in line with the class that we had on the 9th. Let's just keep it nimble. Come October, a lot of folks have asked me, do we stop day trading? Oh, heck no. But what we want to do is start to fire on more cylinders, not supplanting, but supplementing. Meaning, let's keep with the day trading the first 65 minutes of the day. I love that. In 65 minutes, I can get 2 to 4 entries and I can steadily grow my day trading account. But it's my swing trading account that sort of feels very neglected and unloved. And it's not that I don't want to swing trade, but it's that the follow through, as many of you have noticed, has been really, really tricky. And if the follow through isn't there, it's tough to put on overnight exposure for 1 to 3 days or 2 to 10, 1 to 3 for my 60-minute time frame, 2 to 10 for my daily. And ultimately, as we go into Q4, that should start to wake up. I say should because I can't see the future, but if history is any indication, we should start to see better overnight follow through. So that is what I'm super excited about as we get rid of this Q3. We get rid of hopefully a lot of this chop. We look forward to macroeconomically what is very likely the ramp up to a hold for the remainder of the year from the Federal Reserve. And then now we get to see if the Federal Reserve will tighten the timeline instead of July 3-1, the meeting, but hey, can we move it to March or the May meeting? Because that will help the equity markets rally. And yes, I am bullish. By the way, here we are wrapping up the third quarter. I've been bullish for the previous 2. All right, so I haven't changed my tune about being optimistic about favoring the upside for most of my trades. Doesn't mean we don't short. It just doesn't mean that we're not, calling significant, lows. That's been wrong all year, right? So let's keep that in mind. For every time someone says, "Oh yeah, this is the end of," other than a regional bank shocker, which who the heck sets that up in advance? Nobody, because it's one of those events that comes out of nowhere, right? The timing is the difficult part. Maybe you can surf it to the downside, but no one calls the regional bank ahead of time, right? No one calls a bank failure ahead of time. So what we want to remember is while those events will happen, the general gist of the overall equity markets has been up, right? So that's what we've got as we're starting to wrap up 2023. As always, gang, best part of the show is your questions. So let's jump on into them. And good morning. Good morning. All right, good to see everyone. All right, so Hoogly Boogly. All right, Hoogly Boogly asks, can the slow still be used on the weekly chart to see the bigger picture, or is it better suited to lower time frames? Hoogly Boogly, here's what's cool. Let me walk you through the slow still. There is no better overbought, oversold indicator that I have ever found. I've been using this for over 25 years. The slow stochastic's been around for, I think, 75 years. It just works. But here's the key. Hoogly Boogly, HB, yes, you can. However, remember, it's got to be used in a sideways market. Every indicator has, right? Every indicator has a environment that it's best designed for. So for a slow stochastic, that environment is chop. It's a non-trending market. So if you want to apply it to a weekly, we do this pretty regularly. On Tuesdays, we go into weekly timeframes and build longer term positions. Whether that be positions in, and we've got one. I will tell you, I've got one taking some heat right now in McDonald's, and I'm thinking we were looking at QQQ for next week. I believe so. So notice QQQ. QQQ, I don't need a slow stochastic. See, it's a green trend, right? But anything in a sideways trend is where I would utilize that slow stochastic. So something like XLE on the weekly, it's a neutral trend on the weekly, then I would use the slow stochastic. And let me just mention the settings, because the settings are important. Don't mess around with the settings. I see people mess around with their settings. That's just called curve fitting, by the way. Let me give you a little advice. Most people figure this out eventually. If you take an indicator and you change it every whatever, you change the settings, all you're doing is curve fitting, meaning oh, these worked really well in the last 3 months, 6 months, 9 months, right? Let me change the settings. No guarantee that's the way that's going to work going forward. But looking back, the results look brilliant. That's called curve fitting. Um, so what we want to do is find a setting that's slow. I like slowing down an already slow stochastic. So there's a couple ways we can do this. Number one, set it to exponential. That is a choice you have within Thinkorswim. Number two, uh, 80 overbought, 20 oversold. That's traditionally the overbought, oversold for a slow stow. 75-25 is a common default, but 80-20 I have found works the best. And the last bit, and this is really the secret sauce, if you will, a 21K 3D. Slow the slow stochastic way down, right? This is what I've been doing for over 2 decades. Haven't touched the settings an ounce. In fact, I look back at my first book, same settings. I look back at it's so funny to look back at old writing videos that you might have done because the interweb remembers everything. And I go, oh yeah, I'm still using the 34 EMA. I'm still using a 21 3 slow stow. It just works. And remember, on a 5-minute, it's gonna measure 21 5-minute candles. So these settings adjust to the interval in that regard. And on the weekly, it's 21 weekly candles. So I hope that makes sense. All right, next up, and thanks for the question. I love the slow stow. It's just so powerful. It's built into most platforms, but it's the slow, not the regular stochastic, the slow stochastic. All right, next up, Karthik asks, double red on ES. Do we have a short potential? Let's see here. You neglected the time frame, my friend. I don't know what time frame you're talking about, and I don't have a red anywhere on slow stuff on that. Daily? Okay, that helps. All right, daily. Red on the ES. Karthik, the top row is momentum, the bottom row is trend. We are in a neutral trend. We are in a neutral trend, and I'm not interested in a short. No, I'm not interested in a short on the S&P. I'm far more interested in longs on the NAS, but no. Okay, next up, Tech Trader Joe. Is there a time you will turn on the propulsion dots on the 5-minute other than the 200? Probably, just not yet. And I'm not even sure which one I would turn on. Remember, we have an 8, 13, 21, the 200 to 55. We can turn on different propulsion dots depending on which moving average we're interested in seeing. Is there a time? Probably. I don't know when that'll be. Right now, I'll stick with what's working. What's working right now is fewer stuffs on the chart. We've been operating this month. This week kicked my win rate oddly higher. But again, I talked about why I adjusted the win rate. But, I'll stick with what we're doing because our win rate's sitting at about 72 or 3%. So I'll stick with what we're doing. But no, I don't see any reason for more. Thank you for the question. But no, not yet. All right, Perry asks, good morning. As a new trader, how do I work on staying in profitable trades longer? I find myself taking profit too fast and not letting my winners run. So Perry, it's 2 things. One, how are you position sizing at the get-go? When you're building a position, I don't add to winning positions, right? That's not something I've ever done. I've always been told not to do that. And so I'll build my position at the best risk reward ratio that I have. And that's the first entry. Now, that doesn't mean there might not be individual setups along the way, but those are individual trades. So let's talk about a position that you built and taking it for longer. First of all, we need more than one contract. So I know that's super obvious, but we need multiple contracts, which is why scalability, which is what I teach. I don't teach large account management or small account management. All that's irrelevant. What is relevant is what's your account size, what's your max risk, and therefore how many contracts are you allowed to even trade. So account size will be a certain factor predicting how many you can trade, but multiple lots are can be expensive in high-priced options. So affordable, scalable options is really important. The other part is, do you have a plan for past T1? I think the most important thing is not to have an overly ambitious T1. A lot of traders have a T1 predicated on sort of the fairy tale thought that I'll get out of it at 100% return, or I'll get out of it when it's, 2x, whatever that is. Maybe the market doesn't want to go that far and 80% is all it's going to yield that day. Or maybe, rather than saying, oh, I'm going to collect 50%, maybe the market isn't going to go that far. And today, 35% is what we should focus on. So we've got to have a price-based, chart-based goal, target, right? In other words, what's a target? I talk about this all the time in the mastery. Your target is actually an obstacle. When I choose a target on a chart, when we're trading, the question isn't, have I doubled my premium or any other such nonsense? What I ask myself is there something in the way that can prevent price from moving in my favor? That's my target, right? And the better I get at that, the less I worry about return and the more I worry about managing risk. And then if it keeps going, that means that we've hit the first target, moved to break even, hit the second target, move to a trailing stop. And then the last exit's oftentimes going to be time-based. If it's a swing trade, am I getting close to the expiration of the option? If it's a day trade, am I getting close to the end of the day? So that third exit's oftentimes going to be time. All right. That's what I would recommend. But I think at the very onset of the trade is where we are able to position ourselves in such a way that we say, oh, okay, I'm thinking about T2, T3. I'm positioning with a certain number of contracts at the onset of the trade, and I'm managing my risk at each obstacle, aka target. So hope that's something to work with. HB says, I've been using the default sector secret setting. Perfect. That's what I've been using for 25 plus years. It just works. Can we see the RTY? Sure. There you go. It's overall in a downtrend, and it's neutral on the 5-minute. All right, next up, green eggs and ham. Today is long, looking for a tech laggard. I won't know for, so here's a couple things to think about. I can look at, for example, let's jump over to NASDAQ. You mentioned tech. So remember, gang, there are things we can ask ourselves pre-market. So tech laggard, green eggs and ham, I've got a green trend on the 5-minute, right? I've got a green trend on the 5-minute. There are a couple of things that I can look at before the bell. I can change a few settings and I can ask myself, hey, what's going on with ranges accompanying the treasuries open, right? I can look at that and say, hey, are we above or below some key levels based on treasury opens? We're above that. I've got a green trend. See this zone right in here? I'm above that zone. Cool. I can do that again. at the bell, which I will do. So we'll open that up. I'll do a 5-minute, and at the bell, I'll measure that same zone. So I'll look at the first 5 minutes, and by 9:35, I can have another sentiment read. For now, I know a few things, right? Is tech lagging? I don't know. I'd have to compare it to everything else, but right now, I don't think it's any stronger or weaker than anything else. It's an uptrend. It's above that key treasuries opening level. It's above the previous session close, right? So I'll just look for buys, and I'll look for buys in stocks and sectors that are sort of the best example. So when I go into a laggard in a strong market, no, I want to find a stock that is behaving a lot like the NQ or the XLK. And then if it pulls back, I'll take advantage of the retracement. So thanks for the question. All right, next up, we have, thanks, Dee. I appreciate that. Thank you. I appreciate that. I think that's it on the questions. Yep, that's it on the questions. Okay, gang. So as always, thank you so much for being a part of the Charts and Coffee, Caffeinate, and Dominate crew. Gang, always think about risk management. Let's see. Since today is quarterly options expiration. Sorry, Brad, I missed your question. Since today is quarterly options expiration, are you expecting chop? I'm expecting to not engage in this at all, Brad. That's what I'm expecting. Am I expecting chop? Yeah, I'm expecting chop. I'm expecting sort of this magnetism to certain thick open interest levels. I'm expecting a lot of, not even chop. I'm expecting higher volatility, right? I'm expecting, if I look at my hourly price movement ranges and they're studying 68% of the probable volatility for the time of day that we're getting on a Friday. I expect them to be outside that scope. So if I have a tool that has a 68% probability of holding, which HPMRs do, I'm likely going to be operating in that 32%. So it's not chop per se, it's a higher degree of unpredictability. I hope that makes sense. And that predictability is measured by historical volatility. So thanks for the question, Brad. Sorry I missed that earlier. Thank you very much. All right. I will see you all on Sunday for Top Tier Outlook, 6 p.m. And heads up for my trades viz and our room and my trade breakdown for September. That should be out around Tuesday at the Countdown Trader. And that is what we've got, gang. Be good to each other. I'll talk with you soon.